Corporate finance practice problem using OneNote. Reverse stock split. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, then down on in the 1830 Reverse Stock Split tab. Also note, when using OneNote, look at the immersive reader. Our presentations will be down in the text area as well, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations on down below. We're going to go for the reverse stock split this time, noting that the reverse stock split is what it sounds like, the reverse of a stock split. So instead of a stock split, which would increase the number of shares outstanding and reduce then the market price, typically, we have a reverse stock split, which is going to decrease the number of shares outstanding and hopefully increase the stock's price. Now, normally, the stock split, it seems like a more healthy thing that should be happening. The reverse stock split, not so much. We would like a situation generally, if you're owning the company, for the stock price to be going up, possibly going up over the point where you think it's maximizing the potential for investors to want to purchase stock and therefore possibly the ability to generate capital for the company and therefore issue a stock split, reducing the market price to something that might be more in the range, in the sweet spot for investors to want to invest in. On the other side, however, if you're in a situation where the market price is getting quite low, it's below the sweet spot, and you have to basically do a reverse stock split possibly to increase the market price to get to that range where you think it's most marketable. That's usually not as good a sign, and therefore the reverse stock split can result in, an unexpected change to the market, meaning the market could kind of penalize for the reverse stock split in a way that you might not see for the normal stock split, in which case they might actually see that as kind of a beneficial type of thing taking place. Okay, here's the data. We got the stock price at $4. We got the reverse stock split. It's going to be a 1-for-5 stock split. So remember, or 1-for-5 reverse stock split. So remember that a normal stock split situation, you might see like a 5-for-1, meaning you got 5 new shares for every 1 share that was out there before. If it was a split, reverse stock split, for every 5 shares, it's going to be squished down, crunched back down to 1 share out there. We're going to look at it from the standpoint of an investor at this point. So the investor is going to have 100 shares, and let's see the impact on that investor from the reverse stock split. So we got these shares after the split. What's the investor going to be holding after the split? Well, they started off with 100 shares. We're going to multiply that times the split ratio. The split ratio is going to be the 1/5, 1/5. In other words, 1/5 or 0.220%, 1 divided by 5 being 20%. So then we're going to take the 20% times the 100, 20% times 100, and so now we're at the 20 shares. So they had 100 before. Now the 1-for-5 split, we reduced them down to just the 20 shares. They only have 20 shares after this. Now you could see this and say, well, it's pretty obvious for me to see this that I could have just taken, the 100 divided by the 5, and that's fairly self-explanatory, but just realize that you got to be a little bit careful there could be a situation where it's not like a 1-for-5, but like a 2-for-5 or something like that. So you want to keep this kind of ratio concept involved and don't come up with a shortcut that might cause you problems if you were to get like a more strange or complex kind of ratio going on there. So, and then we're going to say, what's the price after the stock split? Well, the price before was $4. We had a $4 price, and then we're going to take that and we're going to have times 1 over the split ratio, 1 over the split ratio. So 1 and then divided by the split ratio, which we calculated to be 0.2 or 1/5, 20%. So 1 over 0.2, or in other words, we got 1 divided by 0.2 or 20% gives us 5. And so we had 4 at the beginning, 4 times 5. Put that in the calculators for the 4. 4 times 5 is going to be the 20 here. And that's going to give us the 20, the price after. Again, you could say, well, it seems pretty straightforward that it's going to be 4 times basically the 5 here. But again, if you had a little bit more complex of a ratio, just make sure you're not taking it into account a shortcut, and just kind of visualize or understand what is happening so that you can make sure you're getting the proper result here. So we got a price then after at the 20 now. So price, if it only increased 80%. So let's imagine a situation where the market perceives this reverse stock split poorly, and they're going to say, well, what if the market reacts and only results in 80% of that price? Meaning it could have a situation where the price would have been 20, and that's what we would expect, everything else equal, given the fact that all we did was a reverse stock split and everything else remains the same, meaning no change to assets or liabilities or to the income or anything like that, just a change in the number of shares. This is what we would expect, the price of 20. But again, the market is the market, and they could react negatively to something like a reverse stock split, for example, possibly only having 80% of what we expect that price to be. 20 times 80% would be the $16. So let's now think about the investor value. Where would the investor stand before this happened, before with the reverse stock split? We had $4 at the price, and so we would have $400. And then afterwards, we had the 20 shares, and the price was 20. So 20 times 20 would then give us the $400. This is what we would expect to happen, everything else equal, if the market didn't penalize them for the change that took place. And then, of course, if they did, if this was the price here, we would still have the 20 shares times the $16, so they could end up in a worse spot if the market perceives the reverse stock split as a negative and penalize it based on the price. Then you could end up in a worse situation. So generally, you would expect, if the market reacts, everything else equal, to be in basically the same spot as you would expect generally for a split. But again, the market could perceive it negatively and possibly penalize for the reverse stock split, because it might not be perceived as a good sign.